Corny, I know, but this quote is extremely relevant to what is going on at the moment, as of today, in property investment in Australia. This is about strategic investment. Be fearful when others are being greedy, and be greedy when others are fearful. Obviously, Warren Buffett, very famous quote, but we have to remember this because the essence of it is very important. High net worth, sophisticated investors, the people that I talk to in that bucket, in that group, get this today. Okay, and this is what we're going to unpack today. Anna and I, we set up our portfolio for life during the GFC and soon after. We were being greedy when others were being fearful. I don't know if greedy is the right word. I think we're just taking advantage of the situation, what was available to us. And that's what I'm going to break down today. Where is the opportunity in very specific terms? The sophisticated, long-term, high net worth investors that I talk to understand that these are the times to allocate capital, to make fortunes. They live this. They truly believe this. They truly own this as a mindset. So I'm going to show you why this is the case. So this is a graph of interest rates in Australia. You can see that it goes up and down, up and down, up and down. We're down at a point here a couple of years ago where we had record low interest rates. And obviously since this has occurred, it has gone up. It has bounced up again. What is the important takeaway from this slide? Really quickly, you can see interest rates here going up month after month after month, going up here, going up here, going up obviously over here quite sharply. What happens when interest rates increase? Well, they only stay high for short periods of time and then they come back down again, further in many cases than they went up. Why does this occur? Okay, RBA are using interest rates to slow down inflation, slow down spend. Once they get the results they are looking for, they have to decrease interest rates very, very quickly. Why is this? Because the RBA's inflation data is lagging. They're in the news at the moment. They've been absolutely grilled by this. The tools they have available are flawed. Their inflation data is lagging. And so when they're making decisions, it's in the rear view mirror. Okay? And as soon as they get the result they're looking for, inflation comes into check, they have to pull interest rates back again to keep the economy going again because they are operating on that lag factor. So when interest rates drop, or even when the RBA stops increasing interest rates, there is a mass pile back into investment grade assets. And property has shown consistently over the last decade it is Australia's safe haven investment grade assets. Okay, this could be before the middle of the year. All we really need to see is a plateau before the media cycle shifts, before sentiment shifts, before those, sheep or the masses are being greedy when others are fearful, or being fearful when others are greedy. They're flipping the switch really quickly, almost in a matter of days or weeks when that sentiment changes. Australians, we're always trying to, compare ourselves to the Joneses, trying to get ahead in life. And so they're, generally the population are very opportunistic and they're just looking for a reason to jump back in and to be greedy, okay, to get themselves ahead. We need to be very strategic with how we operate against these guys. So the key takeaway from this is interest rates go up, but when they do, they come back down again very quickly as soon as the RBA gets the result they're looking for. And remember, the inflation data is lag data. So they have to move quickly to get the economy going again, to stimulate things once they have the result they're getting for. And I would expect as soon as we have 1 month where interest rates don't increase, it might be next month, it might be the month after, then sentiment changes, the media cycle changes. People will start going back to the safe haven assets very quickly. So we have a very limited window. What is this window giving us? So what happens when we are being greedy while others are being fearful? Well, last week, Thursday, Friday, we did 9 deals, 9 offers accepted on property. This is what it's all about. It's leveraging the fearful sellers, okay? It's generating instant equity for our clients on purchase. Over these 9 purchases in 2 days, we were over 5% under market value on average, okay? This is Halvita's property that we purchased for them in Queensland. Very low maintenance, good quality property, solar panels already installed. Guess what? We valued it up at $420,000. That is a fair market appraisal. The asking price was $399. We were able to come in here and purchase it for $385. Okay, this is expert negotiation, off-market properties in many cases of these 9 deals. This is really applying pressure in the right ways. Capital growth is absolutely our number one priority. These are in growing markets. Our research, our data is pointing us towards these growing markets. More on that in a moment. So these are strongly growing markets, and we're able to come into these and really apply our pressure and take advantage of these fearful sellers and generate 9% under market value for Halvida's property. This is $35,000 in instant equity, okay? $385 purchase price, $420 valuation. That's $35,000 equity in Halvida's pocket on day one, right now. Okay, that's how important taking advantage when others are fearful is. This is it personified. We also are about capital growth, right? This is about capital growth. Number one, whilst markets generally went backwards in the last 3 months, using our AI-enabled area selection, we use big data, we use data science, we've been doing this for many years. We are the best in the business. Using this technology, we have kept powering on. And it actually keeps getting better. Quarter into quarter, we are improving and it's getting better and better. But in the last quarter, national average went backwards almost 1.5%. We went forwards almost 5%. It was 4.9% capital growth we've had in the 3 months up until the end of January. So this is live data, very, very recent. This is through Christmas, this is through interest rate rises, this is through all these conversations that are going on. When you're able to target these key markets across Australia, we're really able to deliver results that are moving in a different direction to the masses. And this is what it's all about. The average yield on these purchases was 6.1%, but really importantly, and as I'll talk about in a moment, we had 5.4% rental growth on those acquisitions alone. This is in the first 3 months. So, now, in 3 months, let's summarise. Halvida's property, 4.9% capital growth, 9% under market value. Let's just talk about average results here across our client purchases. This is $40K equity, about $40,000 equity in the first 3 months on a $400,000 acquisition. Okay, this really shows you the power of what we're doing here. We are acting when others are fearful. We're changing our mindset to really look for the opportunities, and we are grabbing them with both hands and delivering ourselves equity in these properties that really sets ourselves up for the future. We're very good at doing this. This is our track record. So you can see the yellow line here is the capital growth we've been able to achieve since 2015 using our predictive algorithm. We are leading the industry in terms of the technology. It's 4.5 times, almost 4.5 times higher capital growth than the average market in Australia. This is, you can see how even through times last year, we've still generated very strong capital growth results. The number one priority is capital growth, high capital growth. This is what we're talking about. It's about being able to create a legacy for your children, your children's children. It's about generating a net worth and wealth within you and your family. And that gives you options. That really does reward and recognize the hard work that you do in your job and earning an income, and you're pushing that into an asset base. And that really does change the future, change the next 20 years. So this is an important concept we need to grasp. It's called dollar cost averaging. Okay, long-term sophisticated investors understand this. They are buying for the long term. They are buying for capital growth. You know, this is a wonderful chart. I didn't put this together. I got it from the Motley Fool, which is an Australian share market commentating company. But this is a very common theory or strategy in share market trading, and it's not really applied in property. But when we know our strategy, when we know the long game, when we are a sophisticated investor, we're not thrown around by the media cycle. We're not thrown around by interest rates increasing or not. Remember, Anna and I bought the bulk of our properties after GFC. Interest rates we were paying 8 or 9% out of our pocket each week. And that's when we were able to be greedy when others were fearful. That's the concept of dollar cost averaging. So assets, they fluctuate over time. You're buying at the high, you're buying at the low, you're buying at the low, you're buying at the high. And you're buying at regular intervals. And because you are being regular with what you're doing, it's averaging it out. Sometimes you're buying at the high, the low, and overall, you're getting good deals all the way through. Overall, you're averaging your entry point into the asset class. Now, the reason why people do this is to reduce risk and maximize returns over the long term. So what I'm talking about now is now you're being greedy while others are fearful. you owe it to yourself to grab the equity out of these properties and to negotiate the eyes out of them with professional assistance and get access to this capital growth in the right key markets now, and then continue acquiring properties as the heat comes into them. But we have to change our strategy very slightly there. And over time, we are dollar cost averaging our entry into the property investment asset class. Now, interest rates are increasing. What is this doing? It's causing people to shift back towards the rental markets. We have record low vacancy rates. We have extreme rental pressure, and this is causing rental prices to increase. We saw before we're generating 5.4% rental increases per quarter, 20% per annum. Rents are going through the roof in the right markets where this shift is occurring. So you've got interest rates and rents rising together. But interest repayments are tax deductible. So what we're seeing now is really powerful because it's minimizing tax as interest repayments and rents are going up together. They're almost cancelling each other out. They're doing a good job of it. But your interest repayments, the more interest you're paying as interest rates are going up, the more you are minimizing your tax. And that's a really important concept that is being applied at the moment. We need to understand these concepts. Now, I'm going to talk about this really quickly. This is More Wealth from Residential Property. I did have a copy of it around the office here, and I think it's gone walkabout. I read this book almost 25 years ago, and it really did have a aha moment for me. And I keep referring back to this over and over and over again over the years. And I can't open the book up and show you the chart in front of the camera, but it's really important to understand this concept. We're buying a property investment for the next 30 years. Okay, we've got a loan for 30 years on this property. We've got times where interest rates are doing this. You know, times when interest rates are going up and times when interest rates are going down over the long term. They might average out to be 5 or 6% over that long term. So overall, the interest you're paying, you would argue, the repayments you're paying on that property on day one are going to be pretty similar as 10-year, 20-year, 30-year. The repayments are going to be pretty much the same. If you're taking this idea of interest rates going up and down, the ebb and the flow of them. But what is really important from this idea is rents are generally indexed to inflation, or they generally go up consistently over time. So overall, on average, it might be 3% per annum rental growth. It might be 4%. Some years it might be 2%, but it very consistently increases in value over time. You're getting compounding on that. So in 20 years' time, you might be getting 3% rental increases on $800 and not $400 now. So this is the real power of compounding applied to the income stream. So over time, your interest repayments are pretty much steady. And over time, the rental return increases consistently. So you might start out with a property, and it is okay to do this. And this is what Anna and I did with many of our properties. They started off as cash flow negative. And then very quickly, the rents keep increasing, interest rates stabilise, they might even decrease very soon in the next few months, and then you're going and you transition a property from negative cash flow into positive cash flow. Back in the day, and I think this is true and this is traditionally over time, it is a 5 or 7 year process to transition a property from negative to positive cash flow. What we are seeing now with 20% rental growth in the market, even if the property starts out as negative cash flow, within a year, it's broken through the interest repayments and is now generating positive cash flow. We're getting 5 years worth of rental growth in 1 year. It's extremely compelling opportunity that is positioning us in the rental side of the market as well. So the rubber needs to hit the road, guys. This is about working with experts to purchase investment-grade assets. We're seeing some excellent opportunities in the right locations now. The moment interest rates stabilise, the media cycle shifts, and this could be weeks away, then sentiment shifts. And the opportunity to negotiate strongly as professional negotiators, it evaporates very, very quickly. So this is an excellent opportunity to make that entry. The next step from here, okay, is a 15-minute discovery call if you are serious about generating wealth and operating through strategy and not fear. Okay, so give Catherine and the team a call, 0361460121. That's our landline on the other side of this wall down here in Hobart. Or email julian@ripehouseadvisory.com.au to book in that 15-minute discovery call and talk about what you're trying to do in property. See if we're a good fit with each other and see if you can operate whilst others are being fearful. Thank you.